All right, guys, welcome to the show. This is awkward because Seth's not here, so we don't have anybody to host or do anything, but we have Trader Mo in the house. He's going to handle your questions and comments.
Yep.
Yeah, you could have filled in for Seth, Mason. Isn't that too bad? So, one of the things we want to do for patrons is do these, individual videos at times that we then, we'll probably put it on our YouTube channel later that you can go back and rewatch, or the patrons who didn't get it can rewatch. If you're not a patron, you're watching this now, this is part of the reason to join our Patreon. You get our everything here, plus you also get to, get these private chats first. And at some point in the future, we'll be charging for these, but of course, all patrons will get them for free. But for right now, we're not charging them on as we grow our user base, but all patrons will get all of these video chats for free. So anyhow, the funny thing that happens is years ago when I started my real estate business, I had started stocks when I was in high school. That's what started me in investing, early, maybe 8th grade. Then after I went to college, I started in real estate because it was more of a business I could run. And so everybody out there thought I was a real estate guy. And then when they found out I did stocks too, they were like, wait, you like stocks? I'm like, yeah. They're like, oh, but real estate's bigger. I'm like, actually, stocks are bigger. And now with the YouTube channel, it's flipped completely. Now everybody's like, wait, you do real estate too? So what I want to do was get into it. We've had a lot of people ask about real estate lately, and I've wanted to get into it and kind of start with a very foundational view of real estate. We're going to have 7 or 8 topics we talk about today. I don't know how long this live stream will go. Mo, if any pertinent questions on what we're discussing at the time come up, please interrupt and tell me. If there's any questions, you know the itinerary. So if there's any questions that you sit there, just respond to people, say it's coming in later, okay, or hey, I think that's a good one, I'll answer. So either way, guys, get the questions coming. We have 117 people currently on. I appreciate that. And so just to start, let me open up a blank page here. So one of the things I first want to discuss is the benefits of real estate, because people hear about real estate and they just think, oh, you buy an office building, an apartment building, and I'm focusing basically on apartment buildings. I'm sure there's a difference between different asset classes, but I'm going to focus on apartment buildings. We've had at one point about 1,000 units. Right now, we're down to 600 and some because we sold a big property. And we're rebuilding. Our goal is to get 1,000 units extra per year for the next 10 years and finish at 10,000 when I turn 50. Real estate's wonderful. Pros of real estate. So here are the pros of real estate. 1, you can touch it. With a stock, you can't go touch the company. I mean, yeah, they have a headquarters, but even that's the real estate part of it. You're basically investing in something that isn't tangible. Now, a lot of people think that's a big deal. To me, I don't. I look at it as a cash flow stream. But the thing people like about real estate is, like, I own this building. I can go touch this building. This building's going to be here. The land itself has value. Even if the building went away tomorrow or tornado came through and knocked it down, the land still has value on a busy street out front. So there's a benefit in that sense for real estate. Can you still be upside down on a property? Absolutely. We saw in the mortgage bubble in 2008, even properties that had tangible, you could touch them. If you own more than the property's worth, basically the land is worth nothing. It's actually a negative value. So one of the big benefits is touch. 2, tax benefits. So one of the things that we have here is the IRS lets you depreciate real estate. So if your property makes $100,000 in profit in a year and lets you depreciate $60,000 of it, that means you only pay tax on $40,000. Now, in the future, when you sell the property, you have to pay taxes on that depreciation amount, but the tax is actually a lot lower. It's a capital gains tax versus ordinary income. So there's an easy way to sit there and make more money on a lower tax rate. Is it a big deal? You know, a lot of people include that in their analysis. When you see our real estate calculator, I do not, because to me, that everybody gets depreciation. Whether you're a good investor or a bad investor, you get depreciation. So I'm never going to factor that in to any of my calculations. I think that's just somebody's attempt to try to make their returns look better. Couple other things, benefits of real estate. Of course, I'm have to pull up this thing all the time. Debt. You can use debt. So one of the big benefits of real estate is you don't have to put all the money up front. When you buy a stock, you tend to have to. And when you use margin to buy stocks, because of how volatile stocks can be, you can get wiped out very easily. Debt, with the real estate, the volatility is very low. There's not a lot of volatility. Like a big year in real estate is prices going up 5%. That's a huge year if nationwide prices went up 5 or 6%. That'd be an astronomical year. And so also going down 5 or 6% in a year would be a big number. Stocks can go down 5% in a day or two. So you can use debt as a way to magnify your returns. And I'll show you that later when I compare a real estate deal using 0 debt, 50% debt, and 80% debt to show you the returns on the same piece of real estate. Okay, monthly recurring income. So another benefit of real estate is monthly income. You know, a lot of people, I'm a big believer. This is why I don't charge you guys a one-time fee for our Everything Money website and our Patreon. I like the monthly recurring income. It's a benefit for me, might be a benefit for you. We all live on month-to-month bills. Your car payment, your mortgage payment, your credit cards, your utilities, they're all month-to-month-to-month. So we all live that way. It's nice to have that monthly income as a pro for real estate. Inflation hedge. Last one is an inflation hedge. And by all means, guys, if you think of another one that you might have, please put it in the chat and Mo will tell me. So inflation is obviously something that, as of late, people have been a little concerned about with how much money we're printing. At some point, we'll have inflation. If you think about it, I think I heard something like lumber prices are up 250% in the last 12 months or 24 months or something crazy. It's a big number, whatever the number is. So if you think about it, when the cost of building something goes up, things that already exist are going to go up in value because to replace that item would cost too much money. So think about it this way. If you had a building that is 20,000 square feet and you paid $2 million for it this year, about $100 a square foot. What if in 5 years the cost to build that same building goes up to 150 a square foot, $3 million bucks? Do you think this building's worth $2 million anymore? No, because if I sat there and said, well, it's worth $2 million, but to replace it would cost, to build it down the street would cost $3 million, I'd rather buy this for, say, hey, I'll pay you $2.7 million. I still save 300 grand, and I take this off your hands. Instead of getting brand new, I'm willing to pay 10% less to have something that's already been built. That's the idea behind the inflation. And also, as inflation occurs, incomes go up, so your rents go up. Makes perfect sense. So as inflation increases, income goes up, therefore your rents go up. As your costs go up, rents go up as well. So it's a good inflation hedge. We're big fans of inflation. You want inflation. The other reason it's also beneficial is when you make a mortgage payment, let's say your mortgage payment's $5,000 a month. In 20 years, what's that mortgage payment? It's still $5,000 a month. But what's happened to your income? Your income's gone up. So you're paying all your mortgage payments the same amount, even though your income goes higher and higher and higher. So it's an inflation hedge. It's a great way to make money off inflation. Okay. Cons of real estate. Illiquid. What does that mean? It is very, very, very hard to turn this building into cash. For me to sell this building and get the cash in my hand would, at best case scenario, take probably 5 or 6 months. I have to get caught to a broker, get a couple brokers to give me their opinion. Then I hire one. Then they got to come up with a marketing packet. They got to send it to everybody. All of a sudden negotiate a deal, negotiate the contract, then go through a closing. That takes 90 days typically on big pieces of real estate. For houses, it can happen a lot quicker, 30 or 45 days. But for big properties like this, a lot more tedious. It's going to take a long time to convert this to cash. As opposed to stocks, you go in your account, you hit sell, it's done. Your money's going to be in your account. It's probably showing your account that day. It's going to appear actually the next day. Very quick clearinghouse. And, oh yes, another big one. Tenants / management. When you buy an ETF for stocks, what are you doing? You're letting them take care of everything, deal with the day-to-day hassles, the BS of managing a company. When you own a real estate, you have to deal with all this stuff. Now you might tell me, well, Paul, you can hire a property manager. If you want to hire a property manager, I want you to do me a favor. I want you to take your cash. I want you to go to the backyard. I want you to fill it in an oil barrel with wood. I want to fill it with oil, a little like lighter fluid. I want you to light the wood on fire. Wait till the fire is really, really big. Then I want to take the contents of your wallet and dump it into the oil barrel and watch your money burn. That is exactly what's going to happen when you hire a third-party manager. I always tell people, if you're not willing to manage the property yourself, don't do it. It's a pain, but it's well worth the return, and it'll help you decide the returns you need in order to manage the property, okay? So the management's a pain, but it's very necessary. You need to learn how to do it. You need to learn how to do it well, or find people that are properly aligned with your goals. Maybe find a partner. You put in half the money, you put in 3/4 of the money, they put in 1/4. You guys split the property profit or something like that. That way they get a benefit from managing. But always be in charge of your own management. Even though it's a pain, it's just like a liquid. This is a pain. That's why you need to get really good returns on your real estate in order to make it worth having to take forever to sell it.
They want to know if you've ever used a management company.
I have many times, and every single time I fired them, and every time I fired them, my costs went down and my rents went up. Every single time. And if somebody like that is telling me, you hired the wrong property manager, just like I've hired the wrong bankers and the wrong lawyer. No. I've had so many property management companies. In fact, people have approached me for property management, and I've said no because I know what to pay. I know how bad it is. Because it's not only just the property manager's fault, it's also the owner's fault. Like usually when an owner hires a management company, they're like, give me a check every month. But they're not there every day seeing the issues in the property.
They want to know, how do you manage so many properties then to grow to where you've gotten to?
I have my in-house team. I don't personally manage it, but I hire my managers. I hire the maintenance people. They all work for us directly. And I compensate them based on the way the property is performing in the metrics that I deem to be important. In fact, I don't pay any of my staff a percentage of profit because I want them to worry about one thing and one thing only, the revenue. Because our goal is to drive revenue as much as possible. The profit will take care of itself. This is what I found. Now, with that said, if I find people spending a little too much money, I will let them know and say, guys, you're spending too much money. We need to pull back a few things here. You're not doing this right. You're not doing that right. But we're very much all about driving revenue and not worrying about profit. Tim, who's upstairs, who runs Dynasty Owner, and soon will be running Everything Money. You'll ask him. He'll be like, listen, I have no idea what they made every year. All I know is the money I brought into the company. That's all I know, the revenue I brought in. Any other questions on this?
Not on this, no.
Okay. So that's pretty much the major pros and cons of real estate. I'm sure there's a few others I don't really remember or care to talk about. Inflation, a lot more management, exactly. Okay, so first thing I want to talk about is debt. Because this is a big deal. This kind of shows you how a piece of real estate makes money. For right now, let's assume you buy a property for $1 million. And you might be, let's say 100,000, because I want to make it numbers that everybody can understand, even though it's just an extra zero. That property today will probably make about $6,500 a year in profit, okay? So you buy a property for $100,000, you'll probably bring in $12,000 or $13,000 in revenue and end up with $6,500 in profit. Very easy to understand. So that means if you paid cash for the property every year, you expect to get $6,500 of cash in your pocket. All right, so if you paid cash for the property, you'd have zero debt, and every year you'd bring $6,500 in, right? Great. What's that return? 6,500 divided by 100,000 equals 6.5%. That doesn't include the property appreciating, doesn't include your tax benefits, just the cash return of 6.5%. We can all understand that because it's 6,500 divided by your actual cash investment of 100,000. So far, so good, right? All right, now let us, actually I shouldn't be doing it on this. I should be doing it on the other page. Let's see here. I actually should be doing it on this. What did I do?
Guys, send me your questions on debt. We're going to go topic by topic.
0% debt.
Paul, erase all that?
Erase all this?
Yeah. See the carrot at the bottom? Down there?
Yeah.
Tap that up. Hit the blue button. Don't save. Now you'll be able to.
Thank you. So 0% debt. As an example, $100,000 property, profit, 6,500, ROI, return on investment, 6.5%. $6,500 in cash at the end of the day, divided by $100,000 investment. Boom. Okay. Now, let's go to 50% debt. So you buy a property for $100,000. You want to have 50% debt on there. So you put 50% down. So you pick an actual cash investment of $50,000. Cash investment. Whenever you're calculating returns, your denominator is the cash you actually put in there. How much cash out of your pocket? Now remember, the property made $6,500, but now with a mortgage on there, you've got to pay a mortgage payment every month. To make it easy, $50,000 mortgage is about $250 a month. Times 12 months is $3,000 a year. You're now left with cash of $3,500. So, again, we're sitting here and we're sitting there saying $50,000 mortgage divided by 200, because that's about the mortgage payment on a 30-year mortgage at about 4% would be $250 a month times 12 is $3,000. 6,500 minus 3,000 is 3,500. Now your return is 3,500 divided by 50,000 equals 7%. So your returns went up, right? Your returns went up. Now, let's go to 80% debt. It gets even bigger, and I'll tell you why. And we'll go back to look at every single one of these. 80% debt. Now you're only putting 20% down. That $100,000 property, now you're investing $20,000 of your cash. You have your $6,500 in profit, and now your mortgage is $80,000. $80,000 mortgage. Your payment every single month is $400 a month times 12 is $4,800. $1,700. So you're like, wait a second, I only make $1,700 now? Yes, but it's based on $20,000 investment now. $1,700 divided by 20,000 equals 8.5%. So just by taking on your mortgage, you took just your cash return from 6.5% to 8.5%. That's a 30% increase in your cash return. Now, I'm going to add a little caveat in here. Let's say every year, your property goes up in value by 3%. So your $100,000 property after year one is now $3,000 higher. So now you made $9,500 instead of $6,500. So $9,500 now divided by 100,000 investment on paying cash is 9.5%. Again, you made $3,000 here. Now add 3,000. Now you're making $6,500 on 50,000. What is that? 12. That's 13% now. Now plus 3K is 4,700 divided by 20 is 23.5%. This is what debt can do for you. The cash returns don't change that much, but once you start making the money on the appreciation of the property, this is where it gets magnified. This is where your returns jump up big time. I didn't even include paying down debt in here. I won't even get into that. I was just talking about cash return and appreciation of the property. So you now took your return from 0% debt and 9.5%, 50% debt of 13%, 80% debt, 23.5%. Now, 80% is a lot. I typically do 70 to 75%. Depends on the property. This is a lot. But at the same point, banks will give it to you. And if you buy the right property with the right procedure, you should never have a problem with 80% mortgage except for flukes like coronavirus or something like that. So this is how you use debt to magnify your returns. We went 2.5 times more return by putting on debt on the property versus no debt. Everybody with me so far? No questions?
You said it before. I don't know if you did principal payment or do you do interest-only payments?
That one actually was principal and interest.
Okay.
I was doing the full mortgage payment.
Okay.
Here, I'm not including the principal pay down as part of the return. That's going to add a few more percentage points to the return here. So you're probably more like 25, 26% here. So I've had friends of mine who say, I want to pay off my property as fast. This is what I talk about when we talk about Dave Ramsey being wrong, about paying off debt. Again, I get it. Dave Ramsey's there for people who have a hard time staying within a budget and have a hard time with money. I get that. But good debt, if you put 70% down, maybe you're at 20% or 18% return. The point is, it's worth putting some debt on there. because you will end up getting a higher. Because at the end of the day, guys, why deal with the hassle of real estate for a 9.5% return? In the long run in stocks, you'll get that 10% return just by buying stocks. Why deal with the hassle of all the management and all that BS?
So your number is 75 to 80%. What about buying their very first property?
I still use 70 to 80% as your number.
Okay.
If you want to be conservative, just call it 75%. Don't exceed that. And on the low side, do 65%. Banks will give you better terms if you the lower rate you do, the lower debt you do.
Okay.
All right.
Yep.
Are you including appreciation into your ROI calculation?
In this one, yes. In this one, I am doing appreciation in here. I am, because remember, this is the $3,000. The 3% inflation on 100 grand. The 3% appreciation on 100 grand. $100,000 property. Every year it's going to go up by 3%. And over time, that's going to lead you to these big returns. Does that make sense to everybody?
Yeah.
Do you think everybody's understanding it well?
Yeah. Yep.
All right, cool. Now, one of the things that we need to...
Oh, one more question from Prajesh.
Oh, boy.
What's the benefit of putting just 20%?
Why even have a mortgage?
Okay.
Oh, you mean...
He's saying put more, I think.
Wait a second. Put more what?
His question is, where was that? What is the benefit of debt putting just 20%? So I think he's saying...
Just putting 20% debt on there?
Yeah.
What is the tax benefit?
Yeah.
Debt doesn't... I mean, there are no tax benefits to having debt.
Thank you, Don.
You get to write off your interest, but everybody gets that no matter what.
Okay.
It's not a tax benefit. It's a cost of doing business. It's an expense.
So you always do debt.
I hate having cash-free properties. I have a few. My Mexico homes are paid off in cash, and
Because
that's why I make 12 to 20% returns every year on them, because I have to, because that money, I wouldn't do it for just 5 or 6% return. That's the reason why we put. That's the reason why we get high returns, because you have to pay cash for them. I never want to have a paid off. My personal residence, guys, I have mortgages.
Somebody asked about that one.
I have a personal mortgage on my residence. Why? Because I'm borrowing at 3%, and I can invest it at 15%. Why would I'm losing 12% a year by paying cash for my house. Same thing with real estate. No difference with the income property. All right, what's next?
Next for you're going to talk about cap rate.
Yep, cap rate. Now, guys.
So guys, submit your questions about cap rate. I know a couple of you have asked what it is and stuff, so here it comes.
Our first ever troll was a cap rate troll. You remember that, Don? Mm-hmm. We had to. I actually had to block him on our account because he was, one, completely wrong, and two, just rude about it. He was just trying to get attention. This is what cap rate is. When you hear about cap rates, people always get cap rate wrong. Cap rate is your profit on your property with no debt.
Paul,
assuming you had, yes.
Can I stop you for 1 second?
Yeah.
I want to go back to debt one more time.
Okay.
Somebody's asking the length of the mortgage.
I always do 25 or 30 years.
Okay, there you go.
When
25
banks
or
tell me 20 years, I tell them to go F themselves.
Okay, all right.
Profit divided by price / total investment. Okay. Remember that $6,500 we were talking about in that property, and you paid 100 grand for it? Your cap rate is 6.5%. Basically, your cap rate is the amount of money you'd make every year if you paid cash for the property, right? Now, here is the hard part. This is the counterintuitive part. As cap rates go down, the price goes up. Think about it. Let's look at it this way. If that same property makes $6,500, if cap rate equals profit divided by price, then price equals profit divided by cap rate. Okay, so sometimes all you know is profit. Then you have to determine, what cap rate do I want on this property? What return do I want in order to justify buying this property? The lower the cap rate, the higher the price. As an example, $6,500. If, let's say, I'm okay with a 5% return, 5%, if I paid cash for the property, instead of 6.5%, I want 5%. $130,000. And think about that. The more you pay for the property, the less your return will be in terms of percentage. So as the return goes down, the price goes up. On the flip side, if you want more money, if you want to make more, if you want to make 10%, now you got to pay $65,000 for the property. So you made a higher return, so you paid a lower price. This is the most confusing part about cap rates. Every time I explain it to people, it confuses them. Every single time, and I get it. But cap rate is very simple once you understand it. It's the return you get if you paid cash for the property. And I'm assuming here that we're talking about a property that's fully stable, already turnkey as it's called. It's already operating, it's fine as is. We don't need to do any work to it, it's just gonna operate fully. The more return you want, the less you have to pay. The higher the cap rate, the less you pay. The lower the cap rate, the higher you pay. Think about it intuitively. If you get less return, you have to pay a higher price. The more you pay for something, the less your return will be. This $6,500 ain't changing. This $6,500 is not changing at all. It's always staying, the profit's staying the same. You just have to remember these equations right here. And then, of course, profit equals price times cap rate. That's it. If you want to figure out the profit of the property, take the price times the cap rate. If the price is 100,000 times 6.5%, profit 6,500. If the price is $1 million and you have a cap rate of 10%, the profit's 100,000. These are the only equations you need to know. As long as you have this one, you can figure out the rest. X equals A over B or whatever the equations you want to use. You can figure out any individual one as long as you have two of them. But the key thing here is the more return you want, the less you pay for the property. So when you're buying, you want to buy at a higher cap rate. When you're selling, you want to sell at a lower cap rate. Because when you're buying at a higher cap rate, the price is low. When you're selling at a low cap rate, the price is high. Cap rate and price move in opposite directions.
What's the cap rate that you guys look for?
Great
at
question.
Crossroads?
Now, this is where the troll was wrong. What is the appropriate cap rate? Well, what's my interest rate? That's the big thing. If interest rates are 10% and my cap rate is 6.5%, I'm going to lose money all day long because I'm paying 10% to make 6.5%. Remember the whole thing about interest rates. You pay whatever you pay on your interest rates. You pay cash for something if the interest rate's going to be higher than your return on investment. If my interest rate is 2%, I might be willing to pay at a 4.5% cap rate. I'm willing to pay more because the rates are lower. So as interest rates fluctuate, think about your home. When rates go lower, are you paying more or less? Are you willing to pay more or less for your home to get the same mortgage payment? You're willing to pay more for the mortgage payment. You're willing to pay more for the home because your mortgage payment will adjust. Same thing here. I'm willing to pay, it also depends, cap rate also depends on how much work. Class A, Class B, Class C. Class A properties, brand new, amazing Park Avenue, amazing properties, highest quality tenant, amazing. Class B, a little bit, probably older, but nice still. Class C, not good. Less work, a little bit of work, more work. The more work I have to do, the higher my return to be. Remember before I said one of the part of the hassles of real estate is the work. The more work I'm going to do, the more return I want.
Do you have a preference?
I like these two. Why? Because nobody else likes these two. A lot of people like Bs. I like B minus to C. I like to make my Cs into C pluses and B minuses, and I want to make B minuses into Bs or strong B pluses. I don't like Class A. Class A makes the least amount of money. You might look at one of those brand new buildings and go, man, that place probably makes a ton of money. I'm telling you right now, they did not make a lot of money. They have to put a lot of down payment down in order to make that thing work. Cash flow. But they're hoping for appreciation over long periods of time. Mm-hmm. I won't get into this discussion right now. But just like we've always discussed, guys, the more demand there is for something, the higher the price goes. There's most demand here, second most here, third most here. So which one do you think are mispriced the most? Class A's are always the most mispriced. Now, does that mean they don't do very well? Absolutely, they do very, very well. But when there's euphoric times, these tend to be the most overpriced. When we had there was a guy who spoke at a big convention I was at, and I agreed with them. I had Class B and C in 2008 and 2009. Nothing happened to me. Not a single thing happened to me. Our collection, our rents kept going up and everything. The Class A friends of mine had the problems. Why? These are all the bankers who all lost their jobs. The highest rents in the area are going to be Class A. When things get tough, the economy goes down, they move to Class B. Class B people move to Class C. Class C people move home or something. They go share places. I'm always fine being right here. This is where I like to be. And funny thing is, my properties, and they're not the nice. We try to make it the nicest on the street. That's our goal, make it the nicest in the area. Now we're not in the hood. We don't have hood properties, but we have Class C. Any other questions?
Yeah. Do cap rates factor property taxes?
Yes. Cap rates are profit. It's after all your expenses. The 6,500 we were talking about was after all expenses: maintenance, property insurance, property taxes, management fees, utilities, every possible expense you can have. Because remember, that's $6,500 in profit here. Maybe we collected $13,000, and then we paid $2,000 for property taxes, $1,000 for insurance, $500 for utilities, blah, blah, all the way down until you got profit of $6,500. Expense, all the way down to $6,500 in profit. The cap rate is based on the profit of the property. Now, I have this one cousin who I love, and he keeps calculating cap rate based on the revenue. It is not based on the revenue. They'll call it a gross cap rate. Stop calling it a gross cap rate. It's a manipulation to get you feel like you're paying less for a property. Because what sounds better, 13% on a $100,000 property or 6.5% on a $100,000 property? This sounds better, but it's misleading because every area has different expenses. All that matters is how much am I taking away? I don't care what area you're in. What matters is how much is going to my bottom line at the end of the day. That's what I pay my mortgage with. Yes, I pay my mortgage with this, but one area could have we're in Ohio. We have a high property tax rate, right? You could be in Texas with a very low property tax rate. Very different taxes. So comparing revenue and gross cap rate doesn't make any sense. Because the revenue could be the same, but the bottom line profit could be totally different. But if the profits are the same, easier to understand. Okay, if I'm gonna make $6,500 in profit in Ohio and $6,500 in Texas, I have to make a decision about where I think the rents are going in that area long term. That's it.
Can you explain what you do to Class B and C properties, like renovations, finding tenants, etc.?
Yes, I can. And that's let's see here. Don't save this. Why is it doing that?
And is there any? How do you find what class the property is?
Is
it on a website somewhere?
It's basically what you figured out to me. You'll figure it out pretty quick.
Okay.
Rogue Fitness just paid us a refund.
Nice.
Good. So let me find my sheet here.
You guys don't do any Airbnb rentals, right?
We don't.
Okay.
Turnkey versus value add. All right, guys, turnkey is you buy the property and it's in this condition you want it to be. You're just managing it from day one, as is. You're not doing anything to the property. That's Class A usually. By the way, a lot of Class A, B, and C people don't do anything to the property. What we do is we want to come in and find a property that's called value add. I remember the story. 13 years ago, I met with a group of bankers, and I was buying a lot of property in a place called Shaker Heights, a lot of old properties. I was later told by one of the guys in the room that after I left the room, they all think about how crazy I was putting all this money in the properties to get higher rents. And they're like, no, now you cannot find out, you actually will get a better deal buying a new property than buying a value add. Value adds where you make the money, but it'll go in cycles because eventually people will overpay. They'll get screwed on it. They won't make the returns they want, and profit will go down. Just like back then, I was the one buying value add. Nobody else was, and that's why I was able to make a lot of money. I find properties where I think the rents are low, the property is in bad shape, and I can put money into it. Now, how much money do I put into it? On average, about $15,000 per unit. And for that, I want about $200 a month increase in rent. Okay, now let me explain to you why this makes sense. You might be sitting there saying, oh, well, Paul then makes $2,400 a year more, and he paid 15 grand for it. So now he's making, what is that, 16%? Somebody do the math for me. That's not right.
What is it?
2,400 divided by 15,000. Actually, it is right. Yeah, it is. Is it 16%?
Yeah, you're right.
Okay, 16% return, which is awesome. You're making 16% return on every dollar you invest. Return on invested capital is 16%. And every additional invested capital is 16%. That's awesome. But that's not where the big money is for me. The big money for it is this. This is where it get a little confusing. I'm now making $2,400 a year more in rent. How much more does that cost me and all my expenses along the way? Anybody want to guess? Usually, $0 more. In fact, usually my expenses go down. And the reason being is I get better quality tenants, less maintenance issues, people who take care of the property more. So my expenses actually will go down, but let's assume my expenses don't go up anymore. I'm now making $2,400 a year more on that same unit. So what does that mean? Well, guys, if I make $2,400 a year more and I bought at a 6.5% cap rate, now it's going to tell me how much will my property increase in value now because of that $2,400. Remember, profit divided by cap rate equals value. So what's 2,400?
Let me do it.
Yeah, 2,400 divided by 0.065.
36,923.
$37,000. I've now increased the value of my property by $37,000, and I paid $15,000 to get it. I made $22,000. That's the way I look at it. I look at it as if I have 100 units here, I just made $2.2 million. If I have 10 units, I just made $220,000. If I have 1 unit, I made $22,000. Yes, the rents matter, but that drives the property value. The way I look at it is I'm making $2,400 a year more at a 6.5% cap rate. I'm making $22,000. That increases the value of the property by $37,000. It costs me $15,000. I'm making $22,000. Some might argue this cap rate will actually go down as the property gets nicer. So maybe it becomes a 6 cap. Hey, what's your name? Mo.
Yes.
What's 2,400 divided by 6%?
40,000.
$40,000. They might sit there and say, well, Paul, it's a nicer property. It's going to mean more demand. You're going to have better quality tenants. The cap rate should go lower. The price should go higher. Now I'm making $25,000 per unit. That is how I make money in value add. I only do value add. I refuse to buy a property that's already stabilized and already rehabbed. I want to do this work. And that's why you see now people overpay like crazy. Now they're willing to pay $15,000, $20,000 more than they normally would have because they're like, oh, I'm still making money on this. Me, I need my margin, or else I'm not willing to do it. I'd rather just go invest in my current properties and upgrade more there. And this is also why buying real estate's awesome, because you can always take your cash flow from your other things in life and reinvest back in your property. If you saw, I make $2,400 on every $15,000 that I invest, 16%. Guys, let me ask you a question. What areas in your life can you take cash that you currently saved and invest it into yourself to make a 16% return? Not guaranteed, but pretty likely. The great thing about real estate is when you have 100 units, try this on 1 unit. Spend $15,000 one time. See if you get the increase. If you don't, you stop. What's the big deal? Even if you have 10 units, do it to 1. Worst case scenario, you have a better tenant paying you $125 more and it's an easier life. That's the worst case scenario. What's the big deal? That's why I love doing this so much. I'm paying myself a 16% return. Why in God's name would I ever pay off my current house? I'd rather just have the mortgage and go invest back in my current properties. Does that make sense? Mm-hmm. Are people understanding this?
Yeah, they are. They want to know. The good question. Here's a good question. How do you value a property?
Okay. In a very simplistic way. So that's value add versus turnkey properties, right, guys? That's the important part.
Would value add compress the cap rate?
It can, and here's why. Because people want the value add so bad that they're willing to pay a lower cap rate.
Okay.
They're going to push the cap rate down going, just like everything in life, guys. If a property makes $6,500 a year, let's stick with that example. Let's say it started at a 6.5% cap rate, so $100,000 in value. As more and more people want it, somebody else will say, well, you know what? Maybe I'll pay a 6% cap rate. Oh, maybe I'll pay a 5% cap rate. It just keeps going down and down and down. All they do is they change their assumptions to justify their cap rate. Well, it's property values are going up a lot, so we can pay less for it. That's what causes bubbles, guys. That's exactly what causes bubbles. I don't play the cap rate compression game unless there's a legitimate reason to, like a value add process. And a long-term rate locked in. But I like to lock my rates in long-term because I invest so much in my property, I want to be able to refinance it in the future and get my money out of it and go do it again. What else you got there?
Opportunity zone. Somebody asked
I'm
about
not going to talk about opportunity zones.
Okay.
Talk about the most overhyped thing in the world. I saw it on Billions recently. I just about gagged.
Do you avoid HOA communities?
No, it's just a fact. You have to factor in the expenses.
Okay.
Just factor in the expenses.
You
Now, go ahead.
prefer flips or rentals?
I like both. I do them both.
Okay.
I do both flips and rentals. And we're going to have a flip calculator and a real estate calculator in our Everything Money app. Let me show you guys exactly the Everything Money app. Should I show it right now?
If you want to.
I think we should.
Here's a question. This question keeps coming in.
Yep.
LLC, buy it through an LLC or individual. I'm assuming that they mean is just an individual person doing their first
buy
house.
an LLC. If you're going to buy
do
it
through an
individually,
LLC.
if you're only going to have a few properties, buy it individually. But please make sure you insure yourself, over-insure yourself, because tenants will take advantage of you. I've been sued so many times for frivolous. I had one time a guy go on his third floor balcony, go over the railing, start doing chin-ups off the railing into the courtyard. Chin-ups. So guys, this is the railing. He goes over the railing, hanging over the courtyard, started doing chin-ups. Did this for months and months. Finally, the thing broke. He fell to the ground, and he sued me for a faulty railing. We won. Come on. But guess what? I go spend $10,000 to fight that guy. Why? Because he wanted to sue me because he thought it was reasonable to go out there and do chin-ups off the railing into the courtyard. Okay. I once had a person sue me because they said in the middle of the night, a bat flew into their chimney, came, rested on their face, bit them, and flew right back out again. Did they have the bat? No. Did they see the bat? No. They just woke up in the morning with a bite. These are the things you deal with. Over-insure yourself.
Wow. Okay.
What?
Andrew's told me some good stories too.
Oh, I bet.
About what? Oh, there was one he told me about. You had a tenant somewhere. They were slaughtering chickens in one of their units. That was the greatest story of all time. So
a question happened. Guys, every single thing I did here, the $100,000 property is one unit or something like that. I don't care what it is. Take it down to 50,000. I don't care. The numbers all are the same no matter what level you're doing. It's still the same calculation. It's all the same calculation. Doesn't matter if you're buying 1,000 units or 100 units or 10 units or 2 units. You should calculate the same way. Your expenses will be different the bigger and smaller you are. It's actually easier and more cost effective to own a larger property. It's a very big misnomer. People think bigger properties are harder. They're actually easier. Everybody's in one location. You can handle the maintenance staff. It costs us more money to manage our single family homes than our apartment buildings. Why? Because we have to send somebody here, there for the single family homes. They're all over the place. Apartment community, right here. Everybody's right there. Maintenance guys are there. Leasing people are there. Groundskeepers are there. Everything is set there. Now, what do you always hear in real estate? Location, location, location. Stupidest thing I've ever heard in my entire life. No, it's equally as dumb as get a college degree at any cost. You guys remember this one? It doesn't matter. It'll all pay off in the long run. Every major problem, every time the masses think something, they are wrong. When location, all it leads to is overpaying. Guys, real estate is no different. These people are just as dumb as the average Robinhood investor with their phone. I've met people who have thousands of units who are absolute idiots when it comes to investing. I once lost a deal with somebody because there were 2 guys in a room with 5,000 units and they were explaining to me their numbers and I was like, you guys have no idea what you're doing. That's not the reason I lost the deal. I said something else that was kind of offensive, which Mikey doesn't let me talk about. But they had 5,000 units and they had no clue what they were doing. They literally had no clue. I was asking their rents, their expenses, their cap rates, and it wasn't adding up. It was not adding up. These guys don't know anything just like everybody else. Location is the dumbest thing in the world. It just leads to overpaying. Because now all you're going to say is, well, I'm at the corner of Maine and Maine. Let me pay whatever it takes to get this location. Well, that's the case. Hey, if they're asking $10 million, go pay $1 billion. You might sit there and say that's extreme. It's not extreme. It's the best location out there. So it does matter. Location at what price? At what price? Just like stocks, guys. This will have the most rental growth. But if you pay too much, it will cost you money. It will always cost you money if you pay too much. I don't care how good the location is. The thing I like is find the least desirable location. I like the Midwest. I like finding growing markets in the Midwest because people ignore those. People are always going to Arizona, Florida, Texas, California. They're always overpaying over there. I can find the same rents and the same profit in the Midwest that'll grow 3 to 4% a year. Just like, if you go look at history, I once wrote an article, and I wish I had it again, where I compared buying a single family home in Cleveland versus California and comparing the two, how much the California probably had to appreciate in value to equate the Cleveland ownership one. And it was like 7.4% a year, which had never happened over a 30-year period in California history. That's what happens when you overpay for something. When you overpay, you have to get things that have never happened before. It's just like Tesla. Could Tesla be worth $500 billion someday, justifiably? Sure. Is it possible? Sure. Is it probable? Absolutely not. Has it ever happened in history? No, it is not. So that's the point. It's the same thing here with location. Whenever people say this, it's them hiding behind the fact they don't know what they're talking about. Just like a college degree will always pay off. Sure, now you have 400 grand in debt because you went and got a liberal arts degree, art history degree from Harvard or Princeton. Congratulations, you are now broke. I don't know how you're going to pay that $400,000 in debt, asking somebody if they want a grande or a latte or a venti or whatever it is.
Stock options that they give you from Starbucks.
That's right. So, location is the biggest crock I've ever heard in my entire life. It just shows people don't understand. Next thing. Do you have any questions, Mo?
Seth has a good one about, he wants you to talk about selling Shaker to Mendy, but I want to...
Don't mention that name.
I think you should wait.
Go ahead.
I think you should wait until you're done with this topic.
Supply and demand. I once was sitting on a panel with a bunch of guys, one of which was a billionaire, and somebody on the floor said, where would you buy right now? And every single person on the panel, except for me, said, I would buy wherever the population is increasing the most. That is stupid. Here is why. Let's say you have two cities. One with 100 people, both with 100 people. This one is going to 200. This one's going to 150. Which one's more likely to appreciate in value for real estate? If I asked 100 people, 98 would say this one. Okay, this one currently has 100 houses. This one currently has 100 houses. But this one's growing a ton. So a bunch of builders come in and they build 250 houses, 150 houses more for 250. This one, they build 50 houses more to meet the demand, 150. Which one's going to have higher real estate prices at this point? This one's going to have higher real estate prices. Supply and demand. It's not just demand. The supply side matters. If you go look at historical real estate appreciation prices, the state of West Virginia has lost population since 1980, but its real estate prices have gone up. Why is that? Because one thing matters in real estate property. What matters the most? Inflation, like we talked about earlier. The devaluation of the dollar, which is happening forever. And that is why real estate prices will always go up. As long as this is happening, real estate prices will go up over long periods of time. Has nothing to do with supply and demand. Does that drive it? Of course. But New York City is a place where I can sit there and see supply and demand affecting things. Why? There's limited land. You can only go up, and it's really, really hard to go up. They make it very difficult to go up. That is why you see such high appreciation prices. And by the way, go look at the population growth in New York. It is way, way lower than the property appreciation. Because it's so hard to go up, properties do appreciate in value much more. And even now, they're seeing a big drop in property values because of the rents, people exiting New York because of COVID. But you gotta remember the supply side of this equation. It doesn't matter it's growing. If you have a city that's not growing at all, if it's going to 100 people staying the same, but they demolish houses, you're gonna have properties go up in value. Because now you only have 90 houses to support 100 people. What's going to happen to prices? The demand and supply are not equal. Here, demand and supply are not equal to the other side. You have to look at both factors. And when you hear all these idiots say, oh, I'm going to go to the city that has the highest population growth. Great, it also has the highest number of people going there to go make money by building more houses. And eventually, this is what happened in Vegas in the late 2000s. Look what happened in Florida in the late 2000s. Look at the biggest crashes in metropolitan, not like inner cities, in actual states. The biggest crashes happened in the fastest growing markets. Why? Because they were the most overpriced. Why? Because everybody wanted to be there, so it drove up prices to nosebleed levels. That is why Ohio didn't fall by, I think there were parts of Arizona and California that fell 60, 70% in the crash.
Wow.
Okay. If they're so amazing because people are going there, why weren't their prices staying steady? Because supply and demand does matter. And all of a sudden you get a massive influx of supply. That's why whenever you look at why have home prices been up so much, they always talk about the supply of new homes is low. So it's amazing to me, they care about supply when it comes to that. But when it comes to actual long-term metrics, they don't care about it. Don't be afraid of the population that's going nowhere. Use that as your opportunity to find deals where people aren't finding deals. Just make sure you pay attention to what's the supply and demand going. What else is going on here?
I have a lot of questions. They're just kind of.
I'm done with everything I want to talk about.
I'm just going to ask you random questions. How about that?
Go for it.
Okay. If you inherited a property, would you sell it or refinance it if they want to rent it? Would they just sell it or rent it?
I would do the numbers and see if I invest X amount of dollars, will I get a good return on my money, and am I willing to be a landlord? The biggest issue is, are you willing to be a landlord? It's a great question to ask. That question is a great question to ask. If you inherit a property, there's no cut and dry yes or no. What matters is, you're talking about money here. What matters is money in, money out. If you can go invest a little bit of money into a project to make a lot more money, why wouldn't you? Unless you just don't want to do it, which I will never fight that. If you don't want to be a property manager, by all means, don't do it.
How do you figure out the numbers without owning the property? Like if the realtors are not giving you all of the correct information?
First off, I want you to do me a favor. When a realtor gives you a number, I want you to look in front of them, and I want you to rip it right in front of them, crumble it up, and throw it as fast as you can at their faces, because it's probably a lie. What you need to do is go find somebody who owns properties and say, what does it cost you to manage this property? Give me the nitty gritty. I learned the hard way. I managed myself because my realtor and the brokers gave me numbers that were absolute lies. I've never seen a realtor or broker actually give the right numbers. Ever. Not one time. And if anybody tries to tell me you don't take the right realtor or broker, you are the sucker at the table. I get so livid about this that people trust these people. They're there to make a commission. They're there to make, a good friend of mine who's a realtor, she was once pushing me to buy a deal, and I finally said to her, I'll tell you what, I'll do the deal, but you throw your commission in as the investment. You know what they said to me? Oh, well, wait a second, let me go run the numbers first real quick. I'm like, wait a second, I thought it was an amazing deal. That's the point. Oh, as Warren Buffett says, always be wary of anybody who's giving you advice and they're gonna make money, they're gonna make a commission off of your decision. Don't listen to them. Go learn on your own. Oh, or your Patreon, you ask me. Done.
True.
Go to the higher level. Guys, if you're gonna buy a big property, you should be in the highest level. It'll pay for itself so many times over. Go ahead.
How do you weed out bad tenants before you let rent?
Great question. Guys, the nicer your property, do background checks, be very strict. Being strict on tenants will pay off in the long run, because at the end of the day, it doesn't matter how physically occupied your property is, it's financial. If you have bad tenants, it'll cause good tenants to leave. Bad tenants cause good tenants to leave. Take the short-term pain of kicking out bad tenants or not renting to bad tenants. Trust me when I say it's worth it. Increase your marketing, increase your advertising, make sure the phones ring up the hook, go show 1,000 units so you can be the one deciding who the person is that's going to rent. Be very strict in the back. You know how many landlords don't even do a background check? Terrible. Do credit check, background check, make sure they have the money, look at pay stubs, everything.
When you were buying, well, people want to know what you did back in the crash in 08 and whatnot.
I was buying everything under the sun.
What was the cap rate that you were
targeting
back then?
Guys, I wasn't even looking at cap rate because of how ridiculous it was. It was probably 12 or 13% if I were to guess. Our properties have gone up so much. I have not.
Listening to those stories is incredible.
Literally, guys, I have houses that I bought in 2009, 10 that I never had debt on that make me 15 or 16% returns with no debt. You saw the numbers before. With debt, they make me 40, 50% returns, not exaggerate, if not more. It was insane back then, guys. If you had cash, literally we were buying properties set in sand. I'd literally tell people, is the foundation good? Yes? Okay, I'll take it. It was crazy back then.
Were you doing inspections?
No, we weren't doing inspections.
Okay.
We do inspections on some properties, but if we buy a crappy property that we know is in bad condition, we'll hire an engineer to make sure the property's not falling down. That's pretty much it.
Okay. Section 8 housing.
Yeah.
Do you buy Section 8 housing? Do you move properties into Section 8?
I take Section 8 housing out of it because you can't raise rents. Section 8 will pay you based on the size of the unit, not based on the quality of the unit as much.
tips on land for hunting, leasing, etc.
We're doing that now. I don't have anything to do with it.
Okay. Let's see. Okay, here's one. Would a 401k loan be smart for purchasing a property?
How comfortable you feel about that one? I don't know. You can invest in real estate through a Roth IRA. I do know that, or an IRA.
Yeah, I've heard that you can.
Yeah, I would just look into that. I don't know how to do it. I'm not a tax expert, I'm not that kind of expert, but I know people have invested in properties using the IRAs.
In your opinion, is it practical for someone with zero experience in real estate and making under $80,000 a year? Is this practical for them to get into?
Yeah, try one unit. Buy one single family home. Give it a shot. Manage it yourself. What's the worst case? You have to sell it? Okay. Figure out a way.
Right now, would you pull 20% out of equities to go and put a down payment on a rental property?
I would not. I'd stick to my plan of buying ETFs every single month, and I'd save more money for a real estate investment.
What kind of returns do you aim for? Minimum.
Depends on the
typically
property.
say 15, right?
Depends on the property, but I'm looking for an IRR on a stabilized deal of 15%. If I have to put money into it, 20+%. The reason being is I'm gonna go do work, pay me for it. I'm gonna go take risk, I wanna be paid for it. So I want minimum 15% IRR and at least 20% if I'm putting money into it.
How often do you raise rents?
As often as I can. Every single year. Every single time a unit goes empty, can we upgrade something here and raise rents? Yes, okay, go do it. I raise rents all the time. Bankers hate hearing this. I want to be the most expensive apartments on the street. Absolutely. And guess what? When I am, we stay full because people want nice stuff. If you or your kids were looking for an apartment today, would you want them living in a dumpy, ugly, cheap one or a really nice, expensive one? There's a happy balance between all of it.
What is IRR?
Internal rate of return. Just figure it as your return. Internal rate of return, I won't get into it, but I'm looking for 15% on stabilized and 20% plus on rehab. It's basically how much money I'm gonna make if I reinvested all that capital, the extra capital into the property in the same return kind of expectation. That's the dumb version of it.
What's the best piece of advice you've ever received from real estate investors you have talked to over your investing career?
I do the opposite of what they tell me.
That's what I thought the answer was going to be.
Guys, literally, I'm telling you right now, everybody has their own style. I don't think I've ever met a real estate investor I go, yeah, I agree with that. I take it, just like value investing though. I take little bits from every single person. I never did rehab until 2 or 3 years into my real estate game. Then I started doing rehab. It's totally different depending on, you just have to figure out what works for you. It's just like when we talk about value investing, momentum trading, and chart reading. You have to find 1 or 2 or 3 that work for you. Find what works for you in real estate. My method might not work for you. If it doesn't make sense to you, don't do it. You shouldn't do it. But I listen to people who aren't offering me advice. That's who I listen to.
Yeah, true.
That's in everything in life.
That is true. When you're getting loans, do you look at big banks, small banks?
That's an excellent question. Yep. It depends on the property. I like a combination of both. The plus side of the big banks is you're gonna get better terms. The downside of the big banks is you're just a number to them. The last thing you ever think about is relationship. The only person that will give you a relationship is if you give a lot of business to one small bank. I hate to say this, and if you went under, they would have a problem. I go to small banks. I'm not big enough to cause any big a problem. I go to small banks when I need somebody in the community to understand the project specifically and go, yeah, we see the upside here. Or I have had one bank. There's a bank in Columbus and our banker there is awesome. I've known her for 10 years. She's phenomenal. And I hate bankers. And I love this woman. And because I went there and met them and showed them my investment philosophy and they bought into my investment philosophy. And they do deals because of us. Go ahead.
Are there scenarios where you sell properties?
Yes. When things are very, very, very expensive, and we think, I sold my shaker portfolio because I didn't like the property taxes and I didn't like the way the area was going, and all the residents in the area were all wanting me to pay for everything that was a problem, and these self-proclaimed, we care about everybody, didn't care about anybody but themselves, and I was like, I'm out. The taxes are going too high, I'm out. It's costing me too much money, I'm out. It was hurting my return every year.
Marcus says, I'm in college with $25,000 in the bank, basically no bills. Should I try and acquire my first property or wait until I graduate and have a real job?
Well, it's gonna be hard to get a loan, I think, if you have no income coming
Yeah,
in.
that's true.
So figure that in.
Wait till you get a real job. Let's see here. What if a tenant doesn't pay their rent?
You evict them. Very simple. Courts are very pro-tenant unless they haven't paid their rent. You have to give them a 3-day notice on the 5th of the month. Make sure you follow up on it, because the second you give weakness, every tenant will hear about it and your collections will plummet. There are stories of us literally buying properties and we tell the staff ahead of time, tell them a new owner is coming in, it's very strict, and the staff will tell us later they've never seen higher collection than we did when we took over. Because if everybody thinks you're gonna be strict on them, they will pay. And if they're not paying, kick them out. You'll find somebody else. You have bills too.
How do you find out if the home inventory in the area is increasing?
You can look, you'll find permits. There'll be data on permits being pulled, population moving in, and you can make estimates based on that. So if you see, for example, population growth is 1,000 people a year, 2.5 people per house, that's 400 households, and you see 1,000 permits being pulled every single year, you got a problem. If you see 300 permits being pulled every year, okay, you have demand. But look over long periods of time, not 1 month at a time.
When you're increasing rents, somebody just wrote Paul is heartless.
I'm not heartless, guys. I have a business to run too.
Yeah, for sure.
And I know I'm gonna get crap from people about this one. They're gonna be randoms who watch this video. You have bills too.
Yes.
Tell me I'm heartless when the bank is telling you, we don't care, make your mortgage payment, we're gonna foreclose on you.
It's been tough with the eviction
Moratorium.
Yeah, exactly.
Yeah.
So this goes back to...
It's so funny. Everybody wants to be open and everything like that until it costs them money. Then all of a sudden they're like, wait a second.
Yep. When you do increase rents, what percentage are you typically looking at?
If we do something to the if we don't do anything to the property, 3 to 4%. If we do something to the property, higher. Just depends on what it demands and all this stuff. I let the market dictate what I'm able to get.
People keep asking. Well, 2 people keep asking about this crowdfunded stuff.
I don't even bother with that one.
Okay. Let's see here. What's the best way to start acquiring properties, like your first property?
Go start looking at a bunch of properties, make ridiculously low offers on a ton of them. That way you get immune to people saying no. The biggest issue I see that people make a mistake on is they fall in love with their first deal and they do anything possible to get it. Hi, I was there and I overpaid because of it. Don't do that. Go look at 100 properties, make offers on 10 of them, and make them low enough where you don't care if 9 of them say no. Just go out there and become immune to being told no. You cannot fall in love with your first deal. You will overpay. It will cost you money. You can never get that money back.
How do you set yourself up legally for success? Contracts, insurance, lawyers, etc.
Listen, that's not the part that's going to make you successful. Your management and your buying is going to make you successful. I mean, yeah, lawyers got to be important, but don't find an idiot lawyer. Find a good lawyer, whatever that means, and have them look over your contract. Make sure you're protected as you go through your entire process, but make sure you're open with them on what you want to accomplish in that transaction. Like if you need protections when you're doing due diligence, ask for those protections. Like, hey, I need this time to be able to inspect make sure you get that.
Is there a typical monthly expense of a property? I mean, it's property to property, right?
Yeah, it's property to property. Okay. Everybody pays a different, like, for example, in Mexico, we pay the electric bill every 2 months. In Ohio, we pay it every month. Mm-hmm. We pay the taxes every month here as it being escrowed. If you don't get escrowed taxes, it's twice a year. It all depends.
Here's a good one. Thoughts on going in 50-50 with a partner?
I think it's great. I think it's a wonderful idea. Just make sure, one, you guys know your clear, defined roles, and you hold each other accountable for them. Don't have roles that overlap. Don't both of you want to be the leasing person and then you want to be the maintenance person. Make sure you both have clearly defined roles that you both separately want to do your own roles.
Adam's saying all property is high right now. Should we wait until another 08 style event?
No. If all properties are high, just wait. There'll be some event that will cause prices to go down. I'm not saying it'll be 08 though. Just like value investing. But guess what? Go convince somebody to sell. You're more likely to get a good deal if nobody else is trying to find it. That's why now when I tell people, find me an off-market deal, the second I hear they've given it to other brokers, I'm like, okay, it's just gonna go to a high price. Give them a reason when you're making an offer, give them a reason to say yes to you. I recently offered all cash close in 2 weeks on a property. They still said no. Because somebody offered them more money and they're like, oh, financing is easy. I don't need all cash. Okay, that's the market. I heard the same thing. What year was it? Oh yeah, 07. What happened that year?
Exactly. Is there more or less value in commercial real estate?
Commercial being office building? I don't like office building because I don't find I get the return on investment. I want to invest back in the property. you're not going to get as big a return on investment rehabbing a unit in the office because everyone's going to come in and go, I want this change, this change, this change. For an apartment, they will give you that. I prefer apartments and houses.
This is a good one. Do you normally include utilities or make your tenants pay it on their own?
I prefer the tenants pay them or we bill them back for it. Because guess what? When they don't pay them, guess what happens to your expenses? Trust me when I say, we used to have people literally leave the faucets on and go to work. All of a sudden we separately build them, the property, we saw like a 30% reduction in our utility costs because they're now responsible for it.
Here's a good one. What do you think of student homes?
I hate them.
Yep.
Guys, everybody in the world loves student housing, and here's why it's wrong. Colleges are going through a problem right now, right? Talk about supply and demand. Supply and demand. Colleges are having people are talking about how expensive colleges are. You better believe it's just a matter of time before colleges say, we're gonna build apartments, and now students are required to live there all 4 years. And then what happens to all the student landlords there who paid for the notes, they said, oh, it's students, colleges aren't going away. That's what's gonna happen. Everybody pays the nose for college housing, and it's a dump. And all it takes is the university making some unilateral decision, which they can make, to say everybody's required to live in our properties to generate more income for them. You will be absolutely screwed. And everybody and their mother thinks student housing is the best investment ever. So what happens to the price? Skyrocket. Everybody thinks it's a supply and demand issue. They worry about this part. All it takes is the supply skyrocketing and their demand going away. That's all that's going to happen. Imagine your property value when the school all of a sudden goes, you know what? We're not going to let you rent from Joe Schmo over there. You got to rent from us for 4 years. That's all it's going to take. And we're going to provide you really beautiful land. Because guess what? They're going to get away with no property taxes because it's a state school or something like that.
If you have a fourplex, what do you think about living in one of the units and renting out 3?
Love it.
Yeah.
Great idea. Just be very clear with your tenants that you're not there to be their buddies or to knock on your door at 2 o'clock at night.
Somebody asked, what's escrow?
Escrow is what you do when you're setting up a purchase or a sale of property. They open escrow with a title agency. It's irrelevant.
Yeah, it is. Okay, this one, they're asking, are there better months to start looking at properties? I don't think so.
I'm sure there is, but I don't really care about that.
All right. That's all the questions you guys have sent in right now, so I think we hit a ton of them. I don't think I have anything left to ask, unless you guys want to get your last few in, but that was a pretty good show.
Yeah, I liked it. I mean, it was faster
I love
than
listening
expected.
to Paul talk about real estate because...
Well, you should like listening to you talk about all investments. Because, by the way, is it any different than when I talk about with stocks?
No, it's exactly the same.
That's what I say. There's no such thing as real estate versus stock. It's investing in general. Has the same principles of supply and demand, overhype, euphoria, everything. It's just a different avenue. That's it.
What's the biggest mistake you've ever made?
Listening to a broker. And I'm not kidding about that, guys. I cannot stress that enough. Do not listen to any broker or realtor. If you think you're talking to a broker or realtor because they're experts, just throw yourself off a building now because you are wasting your time. Just dump your money. Just send me your money as a thank you. Just please do it. I cannot stress this enough, and I really, really, really know that somebody I know who's a realtor out there is going to see this video and get mad at me, and I don't care. The biggest mistake I hear people make, is when they say, oh, but I asked this realtor, they said this is really don't. I literally once went on a tour of properties in Atlanta, and the realtor was being so annoying, I finally said, okay, let's do the numbers. And how stupid he looked when he realized that the numbers he was telling me would have made me lose money on buying the property was incredible. It was the best. I loved it all day long. And by the way, especially don't buy with realtors or brokers who do their own investing. Do not buy from them, because my first question to them is, so where are the good deals if you're taking them all? Oh, I'm not like that. Oh, so you suddenly don't care about making money for yourself. Give me a break. It's a crock. Do not listen to realtors and brokers. In fact, in all my years, I've met one realtor that I love. Ed Joseph is a real estate broker with CBRE in Columbus, Ohio. I want everybody to go to CBRE.com, look up Ed Joseph in Columbus, write him an email and say, Paul Gabriel said you're an amazing human being and the only broker in the world that he trusts. Everybody, please do that. I'm not kidding. Go Ed Joseph, CBRE Columbus. I love this man. Should I do this right here? Mo, I'm going to do this. Ready? I'm going to put a big heart around Ed Joseph. Ed Joseph is the only broker in the world that I trust. I know that he calls me because, Paul, I have a deal for you. He has a deal for me. And he knows when somebody tells him something, he's like, I'm not going to tell Paul that. He won't believe a second of that one.
So people are saying, if we're going out and buying our own home, should we not be trusting realtors?
1,000% don't trust realtors.
That's what he's saying, but he's saying they're saying, should we be our own realtor? No, let them do the deal for you. Just make sure the numbers are correct.
This is what you tell them. Your job is to bring me a deal.
yeah.
I will handle all the numbers. If you don't agree with me on the numbers, I'm fine with that. I'll find a new real estate agent. That's all that matters to you. What I do, when I ask realtors what they think something's worth, I want to see if I can trust them or not. What's it called? Spoiler, I can't. Ed Joseph, CBRE, CB Richard Ellis in Columbus, Ohio. People go write him an email right now and say, Paul Gabriel thinks you're the best broker in the world. Because he is. He's awesome. And that's what the funny thing is, he says to me, he goes, that's probably why I don't make a lot of money. And it's true.
Yeah.
He doesn't make a lot of money because he's honest.
Yeah.
He's a good dude.
Are you guys finding a lot of deals right now?
No.
It's been rough out there.
We had a deal recently in Columbus. Didn't happen because the owners didn't realize that their property management company lied to them about the condition of the property. Shocker. He fired them the day after our inspection because they told us all this information that was absolutely wrong when the owner was there. The owner was pretty embarrassed. I felt bad for the guy because they literally told him the property was in perfect condition and he alone had 3 fire units that weren't even livable.
How do we make sure that the numbers are correct?
Get in the Patreon, go to the highest level, pay, you will get direct access to me, and I will just ask you questions.
Yep.
Think about it from when they give you a maintenance report. The biggest lies I ever see. Here are the 2 biggest things I see missed. 1, real estate taxes. They're going to show you real estate taxes before you sell the property. The second you buy the property, the real estate appraisal will change. You have to account for the change in the price of the property. 2, maintenance and repair. They're going to tell you some ridiculously low number. We always factor in $500 to $700 per unit in maintenance and repair with turnover costs. They're going to show you $150 to $200. That's what it costs them. No, it doesn't. They can go mislead you by changing the numbers amongst properties. I've seen it happen before. Where a property owner will say, I need to get the deal done, so I shifted expenses from this property to another property.
It's funny. I don't have a lot of real estate experience. Any real estate investing I do with Paul and Crossroads Group. But one of my favorite things to do is Andrew's not finding real estate anymore, is he?
I mean, he's looking. But today they had a meeting with that group for the property we're building.
Yeah. So my favorite thing to do is to go into Andrew's office and just sit and watch him go through different properties and whatnot. It is amazing. Every single time there's something wrong with the numbers that they're given. Every single time. And that's just going to his point that they're never truthful with you. Or maybe they're truthful and they're just wrong. It doesn't matter.
Look at it this
they're
way.
Never correct.
And look at it this way. The SEC requires publicly traded companies to be honest with us, and they still lie. Nobody's regulating these realtors and brokers. Like, hey, this is what I was given. I was just given this. So the SEC can't even catch liars. The SEC can't even catch Bernie Madoff. How is anybody going to catch these realtors and brokers who are just trying to sell a property and make a commission? How? That's it. Unfortunately, it's going to take experience, or luckily for all of you, your patrons. If you're not a patron, join at patreon.com/everythingmoney. Get access. It'll be the best decision you make. You get the 8 pillars and the real estate access, and our real estate calculator will be part of the program. Actually, let me pull it up too. Go ahead. Keep talking.
I can answer this one. Are there any major differences when investing in foreign properties? And yeah, there are. So for example, our Mexico properties, we had to go through lawyers and trusts and whatnot. Of course, you have to pay, as a U.S. citizen, we had to pay all cash down there. So they are different. I mean, it's going to vary from country to country. And if you're a U.S. citizen or UK citizen buying in other countries, it's going to be different. So just make sure you know about that.
Okay, so here's what I'm going to do. I'm going to share the screen. This is our real estate calculator program that I'm going to show you guys. This is what comes with the Everything Money app.
And this thing is great, guys.
Today, it'll be sometime this year. Now, this is going to look different, but you're going to have your properties over here. Click on your property. You're going to enter the information, property name, address, city. This is our luxury ZLO. These are properties in Mexico. Number of units, appreciation rate, vacancy, purchase price. This is actually our investment price. Cost to sell. When you sell it, you're going to pay commission, 7%. Years of analysis. Cap rate upon sale. I was assuming selling it at 16% cap rate, which is an insane number. Let's say we sell it at 8% cap rate. Acquisition fee, etc. Go to income. You enter the unit number, number of bedrooms, how much per month, etc. Number of expenses. You input all the expenses. Mortgage. In this situation, we have 0 mortgage. View recap report. It'll give you your yearly revenue, expenses, all this stuff. And then for your IRR. So I make about 22% IRR on my properties in Mexico. It's not bad. And you can go adjust things here and there. It'll tell you your yearly cash flow, etc. Expenses per unit. You can adjust it higher and lower. You can adjust your price higher and lower to see what rates you need to get. And this will all be available for you on Everything Money. If you're a Patreon user, you get Everything Money for free. This will be included this year. It's awesome. It'll help you evaluate every real estate deal you have. It's simple. Everybody else uses these massive Excel sheets. I do not, because it doesn't matter. I stick to cash in and cash out. That's what matters.
Last question here. Is it a good idea to ask other landlords in the area
Go ahead.
to get an estimate on what they look for?
So when you want to get comparable rents, go to apartments.com or apartmentguy.com or Craigslist and look for apartments and houses in the area what they rent for. In terms of expenses, yes, try to find a landlord and just talk to several landlords, not one. Talk to 4 or 5 landlords in the area and say, hey, can I just buy you dinner, buy you lunch, just to pick your brain? I'm coming into the area. What does it cost for you to operate? You will find people willing to help. Buy them something, buy them a meal. They got to eat anyhow. Just say, hey, listen, you got to eat anyhow. Do you mind meeting me for lunch? I will buy you lunch. Let them pick the spot. Absolutely, but don't do it with one. Do it with 4 or 5, because everybody has a different style. If I listened to the first person that I sat down with, I would be a terrible landlord right now. Wonderful human being, but he did not manage his properties correct. Wonderful person, by the way.
I think a good way to end it is to talk about what age you were when you bought your first deal, and talk about your first deal, getting it done.
I was 22 when I did my first deal. I did a 2-family. And I ended up selling it 12 years later for exactly the same price as I paid for it, because I bought it wrong.
All right, there you have it. Paul makes mistakes too, but
That's how we learn.
that's how you learn. As long as you're learning from your mistakes, that is fine to make them. So that's it.
And make sure your mistakes won't bury you. And this is all the more reason why your guys' Patreon access is wonderful, because you guys can learn from everybody in the group. And if you have the highest tier, you can learn from me on real estate and get direct advice.
And guys, in the Paul's Super Shorts, we talk about it often. There is one guy in there. He does a lot of real estate. He's talked to you a lot about it, and he seems to be doing well. But he's always picking Paul's brain on it and talking. And Paul is very quick to answer. And the discussions are really fun to read, because I don't really know a lot about real estate. So I'm learning about this stuff with you guys. So it's pretty awesome.
I wish if I just had 10 minutes with myself 20 years ago, I'd have saved myself multiple 7 figures in mistakes, multiple 7 figures.
Yeah, and $250 for it is pretty good, especially if you're going to go do a deal.
If you're going to do a deal,
I paid $250,
and you get access to Mo for the trading and all that stuff. I mean, this is a no-brainer.
And then you get the real estate, you get me and Paul talking about our investments. I mean, we both invest for our own family offices. That's all we do. This is what we do. So between me talking to you guys in the Trader, what is it called now? Bid and Ask Nation, and talking in the Paul's Super Shorts, this is my life. So 2
comments. Paul's biggest win. I have one property in Columbus that makes me 50% returns. And the funny thing was, I got it because a guy who works upstairs now was a broker at the time. He was on a vacation with me to Mexico, our home in Mexico. He mentioned a property. I'm like, hey, I know that property. Is it for sale? He's like, yeah. I'm like, yeah, I'm in that area. And I ended up buying it. It was a slam. I paid over ask price for that property. That's how much I wanted it, because I knew it was a great deal. I paid over ask price. And they said the owner was a billionaire. He didn't understand the value. That's my point, guys. He was a billionaire. I even offered him a partnership. He said no, and I bought that property for $2.75 million. It recently I put about $1.5 million into it, and it recently plays for $9.2 million. My biggest win. It makes me 50% returns all day. Next question I got was, when's Paul writing a book? Never. I think everybody writes a book. Everybody has good books out there. Just join the channel. This is better. I might write something. I don't know. Matt Jensen, my chess coach. I wrote 37,000 words.
You kind of wrote that.
Yeah, I'm just done with it. Like, I might write about my philosophy of life, but not about investing. It's just, there's too many good things out there. I want you to join I want the people to be in the Patreon learning from me directly.
That's what I think is more valuable, is your philosophy of life, more than his investing. I mean, his investing is awesome, and we do it together and whatnot, but that's what I learned from you the most, is that.
How did I know it was a good deal? I owned a lot of properties in the area. I owned a lot of properties in the area, and I knew the rents were super low. For example, a crappier looking property 2 doors down, I was getting $200 more per month in rent. We bought the property, the rents were $540 a month. We're now getting $900 a month in rent for it. And that was 3 or 4 years ago. Mm-hmm. We're getting $900 a month with our rehab. So you can see, when I wanted $200 a month, I got $400 a month increase almost.
Here, Shaner Man said, I think the hardest part is getting started. That's one of the most important things I've learned from Paul since meeting him. Well, becoming good friends with him 2 years ago is all you have to do is start. That's really it. Here's a question. If the numbers make sense, but the property is unsold for 2 to 3 months, what are you missing? What are we missing?
What was that?
They said if the numbers make sense on the property, but it's unsold for 2 to 3 months, what are you missing?
I used to think the same way, and I used to think the exact same way. Now I'm just confident enough where I know that it's still a good deal. I'm going to do it anyway. I don't listen to anybody else. Let me actually put Ed Joseph's email in here. Let's find it. Ed Joseph's a man. Here he is. Email. What's his email?
This guy's going to get inundated.
Everybody write Ed Joseph an email and say, Paul says you're a great broker. Everybody do this.
This is awesome.
Email and tell.
Yo, Pierre, Paul's not a billionaire. He's gonna be a billionaire, but not a billionaire. I don't know why everyone keeps saying we're billionaires. We're not billionaires. That's like saying. Well, never mind.
It's gonna be a Tesla analogy.
Yeah, it was. It was going to be a Tesla analogy.
Awesome. John, thank you so much. Shane sent him an email. This is great. Ed's going to call me and be like,
I sent him
what
2
is,
emails.
what is going on here? This is awesome.
Funny.
Anyways, what was the other question I had? Somebody else had
I don't know.
Somebody else had a good question.
I want to ask you this one. The increasing interest rates, how's that going to play out in you looking at
I
things?
mean, listen, you would think increasing interest rates would drive down property values. It just depends how fast it happens and how, I don't know. It's like, who knows if we're going to have increase? I don't know where interest rates are going. If you're able to lock in a good loan long term, you shouldn't care about. That's the hard part. It's like, you don't want to play the interest rate game, because 15 years ago when I started, rates were 5 or 6%, and that was low for back then. And I remember thinking, there's no way rates are going to be this low 10 years from now. Boom, they were lower 10 years later. So who knows? But if you find a good deal that you can put money into, don't worry about property values, because if you put money into it, increase values, you'll be okay.
I think that's it.
Yep. All right, guys.
That's it. Thanks, guys.
Thank
Appreciate
you very much. Everyone have a good one, and thanks for listening.
Yeah. See ya.